Hi, this is Isaac here. Just a quick video to show the benefits of using an offset account with your investment loan. So I've put together a little scenario here whereby a taxpayer A has a rental property as well as some excess cash, and they want to know the most tax effective way to structure their personal cash against their investment loan to get the best possible cash flow scenario. So in this scenario, we have taxpayer A. They're paying tax in the 34 cents tax bracket. This includes the Medicare levy. Taxpayer A has an investment property. The property has a loan balance of $300,000 and also earns rental income of $375 per week. They have cash of $20,000. It's currently sitting in a savings account, and they want to know, as I said, the most tax-effective way to hold this. So the investment loan is paying interest at 5%, and the savings account is earning interest at 2.75%. So scenario A is basically going to have these inputs. So I've got two tables down here. One is the calculations, which will show us the net after-tax cash flow, and we'll enter the constants of the scenario into this constants box, which will populate and do our calculations for us. So as per the facts of the scenario, the loan balance is $300,000. The offset account is 0. The investment, so they're paying interest at 5%. The savings account has $20,000 sitting into it, earning interest at 2.75%. Rental income is $375 per week. There are 52 weeks in the year, and the tax rate is 34 cents in the dollar. So in scenario A, we can see that the rental property is earning income of $19,500 per annum. The interest expense on $300,000 is currently $15,000 per annum, which gives taxpayer A a net rental gain of $4,500. The interest earned on their $20,000 in the savings account is $550. So in this scenario, the other taxable income is $5,050. They will pay tax on that at 34 cents, which is $1,717, giving us a net after-tax cash flow of $3,333. So scenario A, without an offset account, has taxable income of $5,050. They pay tax of $1,717. So therefore, their net after-tax cash flow is $3,333. So let's move to scenario B. Let's shift that cash from their savings account into an offset account, whereby reducing the balance of which the interest is calculated on. So the savings account is now going to be 0, and the offset account is going to have $20,000 in it. So how does that affect the situation? Net rental income stays the same. Interest expense has decreased from $15,000 to $14,000, as the taxpayer is now paying interest on the balance of $280,000 as opposed to in scenario A where they were paying interest on $300,000. So their net rental gain has increased by $1,000. Interest earned is 0. They have no money in the savings account, so therefore their taxable income is $5,500. They pay tax of $1,870 on that, giving us our net after-tax cash flow of $3,630. So scenario B with the offset account, taxable income of $5,500, tax paid of $1,870, giving us a net cash flow of $3,630. So by comparing scenario A with scenario B, we can see that in this instance, the taxpayer is better off after tax by $297 per annum by having the money in an offset account as opposed to in their savings account. So why would the taxpayer choose to do this? In this instance, we're assuming the taxpayer has no private debt. So the only debt that they do have is this $300,000, and it is tax-deductible debt as it's being used to produce assessable income by the means of the investment property. So I hope that you found this video informative, showing the difference between having money in a savings account as opposed to putting that money into an offset account. And if you have any questions or would like me to apply the facts of this to your specific situation, please give me a call or an email and we can talk then. Thanks a lot.